Thank you again for joining our webinar. Today we'll be kicking off part one of a three-part series focused on business purpose real estate financing. Today we'll focus on financing 1 to 4 unit investment properties. And I'll be your host today. My name is Craig Blodgett. I'm the partner advocate here at Loanspark. This is my contact info on the board. If you want to save that or reach out to me at any time, I encourage you to do so. And also on this call, I have Thomas Black, my head of capital markets, who will support me in details of the programs, the loan types, the property types, and some of the examples where we were able to finance these deals and kind of paint a why it was beneficial for the borrower. So I'll give a high-level description and I'll kind of introduce the topic today, and then I'll hand it over to Thomas once we get to that point. But before we move into the meat and potatoes here, an important market update tip that I'm sure many of you are all aware of. If not, I'm sure your borrowers are aware of, that the Fed recently cut rates by 50 basis points. That equates to a 0.5% rate drop. Now, it's important to note that Fed rate cuts don't necessarily move in parallel with the rate drops of financial institutions or private lenders. However, for context, when a rate drop of 0.5% occurs, for example, from 8.25% to 7.75%, on a loan amount of, say, $1 million over a 30-year fixed term, the borrower would actually save $350 per month in loan payments. I think it's important to highlight this figure because there is an opportunity on the horizon. There's an expected refinance boom, and I think it's really, really great to keep this in mind when you're speaking with your borrowers. So let's talk about the types of investment properties that would qualify as 1 to 4 unit. First off, let's remember that Loanspark only offers business purpose financing, right? We don't do anything on the primary mortgage space or consumer mortgages. So business purpose loans, investment properties, fix and flips, commercial loans are our forte. And some of the investment properties that would qualify as 1 to 4 unit would be, for example, your run-of-the-mill single-family residence, non-owner occupied, again, duplexes, triplexes, quadplexes, and condos. Warrantable only condos, and the definition of a warrantable only condo, it can vary from state to state, but it has to do with the HOA. So if you have a question about whether that condo is warrantable or non-warrantable, please reach out to me and we can look into that deeper. Also, townhomes would qualify as a 1 to 4 unit investment property. This may also be called an attached single-family residence versus unattached. So these are a few examples of the types of properties that would be considered 1 to 4 unit. There are other types of more specialized properties that would also qualify. So if you're encountering a scenario where you're not sure if your property would qualify as a 1 to 4 unit investment property, please let me know, and we can definitely provide more clarification on that on a case-by-case basis. The types of loan programs that we'll be covering today in today's presentation that are geared towards 1 to 4 unit investment properties are DSCR loans. And I'll give a quick high-level definition of what a DSCR is. DSCR is a debt service coverage ratio. It's a metric used to determine if the income from a property covers the debt of that property. So, for example, if the income of the property is more than the debt or mortgage payment of that property, it would be at a DSCR of 1.0 or higher. If the debt is more than the income on the property, the DSCR would be considered negative and would be less than 1. So that moves us into no DSCR loans. Second mortgages are a tool used to access equity without touching the first position of that note. This is critical in today's interest rate environments because many of your borrowers may have secured financing for their properties 3, 4, 5 years ago when interest rates were much lower, and they don't necessarily want to touch that first position. However, they need access to equity for cash out, for any sort of business purpose related need. Second mortgages are going to be a great tool for them to access that equity without having to refinance the whole first note. And Thomas will go into that in more detail in a moment to explain why that's so important and such a valuable tool that you can use as a partner of Loanspark for your borrowers. And then bridge loans are a form of financing used. It's a temporary, short-term form of financing that's used as a means to either acquire a property or access that equity in place or working towards permanent financing down the road. And again, Thomas will cover all of these in more detail. So Thomas, I will go ahead and hand it off to you now.
All right, thank you very much, Craig. And thanks everyone for joining today. As Craig mentioned, my name is Thomas Black. I'm the head of capital markets here at Loanspark. And one of my main responsibilities, among other things, is to assess a lead when it comes in and determine the best possible program that's going to be a fit for your customer. So one of the things I want to start off by discussing is how we're going to select the right program, what information is going to affect the pricing and terms of the loan, and what information we'd like to collect when the lead comes in to ensure we are pricing and placing the loan in the most accurate fashion. So without further ado, the 4 factors on the screen that you see now are going to be the main drivers for pricing of all of the loans that Craig just mentioned. So they may have varying levels of importance for these loans, but these are all going to be inputs that drive the pricing and terms of these requests. So the first, as Craig mentioned, is the debt service coverage ratio. So essentially, this is measuring whether the income of the property, like you mentioned, is sufficient enough to service the debt on the property. So in cases where you have an excess of income to service the debt, obviously pricing is going to be a lot better than if, a shortage of income to service debt, right? So this is going to be one of the main drivers. Obviously, your borrower profile is going to be very important here, right? So their FICO and their experience mainly. So how many investment properties do they own? Have they owned in the past, right? And what's their credit score? Obviously, these are very important factors in the investor's perception of your borrower's ability to repay, and therefore they affect the risk profile of the customer. And finally, you've got the loan to value of the property, right? So generally speaking, the more money your customer is willing to put down, the less risky of a proposition this request is going to be viewed as, and therefore it's going to impact a lower loan to value will impact pricing in a positive way. Higher loan to value will generally raise pricing. So as far as what we would like to see when a lead comes in to assess which program is going to be the best fit, first and foremost, we always want to see the address, right? Because while we do have the ability to finance rural properties of the property types that Craig mentioned, these options are much more limited and also more expensive. Whereas, if your borrower's 4-unit property is located in a major metropolitan area, say Chicago, New York City, Atlanta, right, you're going to have a plethora of options. So it's really important to understand where the property is located and frankly, be able to put eyes on the property, right? I will immediately pull it up on Google Maps, figure out what it looks like. Is there any concerns related to perhaps just ongoing construction or anything like that? Just being able to put eyes on the property and know what we're working with. The next important factor is what we're going to use to calculate the debt service, which is the income on the property. And notice the slide says and expenses, right? So it's very easy when you're talking to a borrower to ask them what sort of rental income they're generating because they have a lease in hand. It's usually kind of the first number. It's the most important number in their mind. But expenses on the property are equally important, namely taxes and insurance. So when you're submitting a lead, if you have the ability to get this information from your borrower, it's very, very helpful because the more accurate this information is when submitted, the higher the probability that the price quote that was provided is going to be followed through on and approved later down the road. So by way of example, I live in Charleston, South Carolina, so I'm 15 miles from the beach. Now, property taxes in South Carolina are not terribly high. They're fairly low across the nation, but insurance for things like hurricanes is much higher. Juxtaposed against where Cray lives in Texas, right? Property taxes may be a lot higher, insurance may be a lot lower. So having an understanding of these expenses incurred by the property is going to be very helpful in not only securing the best terms, but securing the terms that can be followed through on and ensuring the loan gets approved when the time comes. Obviously, I mentioned the borrower FICO before, so having an estimate of your borrower's FICO, we don't necessarily have to soft pull or anything like that up front, but most of your borrowers and most people on this call have an ability to, whether it's through your Chase app or Amex or whatever it is, you have an ability to view an estimate of your own credit score. So knowing that when the loan comes in is, again, going to allow us to price the loan with as much accuracy as possible. And finally, the borrower's experience. Again, initially, this is self-reported, right? So we're not going to ask you for a comprehensive resume of all of their projects and the scope of work, but we do like to know, hey, they've done 2 properties, they've done 5, they currently own 7 rentals, etc. Right? So again, providing this information with as much accuracy as possible on the front end is going to save everybody involved in the process time and frankly headaches that could come up down the road. So now I want to get into the individual programs that Craig kind of mentioned in the beginning. So we will start with the DSCR loans. So a lot of you on this call may be familiar with this product, right? It has a plethora of names in the industry, but most commonly referred to as a DSCR loan. Basically, what this means is an approval is going to be based strictly on the income and debt of the property. So this is a little bit different than some traditional lending institutions. For example, generally, if you go to a local credit union and you want to buy a duplex as a rental property, they will look at the income of the property, but they're also going to be looking at your personal income and your personal financials, your liquidity, other businesses that you may own, right? They're going to be looking at a wider scope of your financial profile. Whereas this term we use, DSCR loans, we're using it in a manner to suggest approval is based on strictly this individual subject property, right? So is it netting positive cash flow? Is it losing a little bit of money, right? And so in the context of DSCR loans on this slide, we're referring to any loan that has a debt service coverage ratio in excess of 1.0. So the property is netting positive cash flow. So, use cases for this, I mean, I'm sure you can think of a plethora, the most common being individuals who may not want to do a full documentation loan, who may not want to provide years of tax returns, provide K-1s for all their businesses, right? That's just one example. There are many. What I wanted to do was highlight kind of some best case scenario market terms so that you understand, if you have an A+ borrower coming into us, what you could kind of expect from a terms point of view. So for this product, we have terms ranging from 25 all the way up to 40 years. That'd be a 40-year fix. So obviously, very, very competitive there and much lower payments than, say, a 25-year fix. I will say that most of the loans we close of this variety are 30-year fixed. It seems to be the most common that borrower selects, but you do, in the event that the debt service coverage was very tight, right? We're bumping up against that 1.0 threshold. You could switch to a 40-year fix to get that payment down and get the approval there, right? Loan to value is going to max out at 80% here. That means your borrower can purchase one of these properties through this program with only 20% down. Now, I will note that 80% applies to purchases only. So in the event of a refinance or a cash out refinance, your leverage is going to be a little bit lower. So generally on a rate term refinance, we max out at 75, and on a cash out refinance, we max out at 70. These aren't hard lines in the sand. If you have, an A++ borrower and they want 75% on the cash out, it is possible, but these are generally the best you're going to see. Now, right now, rates for this product are extremely competitive, even compared to your traditional lending institutions, your banks and your credit unions, right? So with a borrower who has FICO in excess of 760, 780, and they have a plethora of experience and the debt service looks good on the property, we can get you a rate as low as 5.99. Now, again, this is the perfect borrower. Generally speaking, most borrowers aren't going to meet all of these criteria, but I do want to emphasize that this is possible, and the rates on these products are very, very competitive, even compared to your traditional institutions. Same thing with the origination fees. We can provide these loans with as little as 1% in an origination fee. That would not include, if the deal is brokered, that would not include a broker fee. And I also want to emphasize there is a little bit of give and take between rates and origination fees. For example, it's very unlikely you would see terms showing a rate of 5.99 and an origination fee of 1%. So generally, if your borrower is very rate sensitive and they want to make sure that above all else they have a competitive rate, you're generally going to see something a little bit higher on the origination fee, maybe 1.5%, and vice versa. If they're very cost sensitive to upfront fees, we may be able to do the 1% origination fee, but the rate maybe goes up to 6.5, 6.75, something like that. So I just want to emphasize these are kind of, the best case market terms on an individual criteria level, right? And finally, prepayment penalties. I'm sure most people on this call have had borrowers who are sensitive to having prepayment penalties. The standard for these loans is a 5-year declining prepayment penalty. So 5% paid in the first year, 4% in the second year, et cetera, right? But many of these programs we offer have the ability to buy down the prepayment penalty, be it through origination fees up front or an additional bump to the rate. And so you can buy down the prepayment penalty to as little as 1 year in many cases. I will also note, I don't have a full list here, but there are certain states that do not allow lenders and investors to charge prepayment penalties. So Pennsylvania is one example. If you look for a DSCR loan in Pennsylvania, most of our programs have the ability to provide terms with no prepayment penalty whatsoever. This is maybe 6 to 8 states that offer this, and I'm happy to provide a list after the call if need be. And so again, I wanted to kind of emphasize the terms provided there are very competitive in terms of your traditional lending institutions, and the amount of time in which we can close is far superior, right? We've seen these loans close in as little as 15 days, right, with a motivated borrower. And so I want to emphasize, I've worked at banks in the past. I know some people here have been in these institutions as well. It's very uncommon to see loans closing that quickly. They're more in the 45 to 60 day horizon. So that's one of the hallmarks of this product, I would say. So as an example of a use case for this, right, we financed a purchase recently of a single family residence in Akron, right? So the borrower comes to us, they want to buy this property, right? And they want to put as little money as possible down. They had, a fairly, we'll call it an A- borrower profile, decent credit, a little bit of experience, and we're able to secure them an 80% loan to value at a rate of 7.25%, and the loan closed in 23 days, right? So again, 23 days is probably about average. It's possible to close faster, but all things considered, this is a very, very competitive terms that they would be hard pressed to secure somewhere else to close in that time frame. All right, so the second example and Craig briefly mentioned this at the beginning of the call, is our no DSCR loan program. So we do have a singular program that will actually finance the purchase of these properties without calculating the DSCR whatsoever. But in the context of this slide, no DSCR is referring to a debt service coverage ratio below 1. So like Craig mentioned, the debt on the property exceeds the net income of the property. In other words, the property's cash flow negative. So use cases for something like this. I mean, you may wonder, why would somebody want to buy a property that's cash flow negative? But there are plenty of examples. So one would be if your borrower holds the belief that rates are going to come down, right? And the value of this property is going to hold steady, and he believes he can refinance into a much lower rate in 2 years, right? So if you refinance from something in the 6s to something in the 4s, I'm not speculating, but if your borrower held this belief, buying a property that's cash flow negative may make sense, so that when they refinance in 2 years, all of a sudden the property's cash flow positive. So this is just one example. So terms for loans like this in today's market. Surprisingly, we still can go out to 40-year fix, which some people, on this call may find a bit surprising, but it is the truth. Loan to value is going to be a little bit less here, right? So even on a purchase, if the property is not showing the ability to service its debt, we're going to be maxing out at a 70% LTV. So borrower is going to have to bring 30% down. Now we can do that on refinances as well. But again, obviously, when the subject property is not showing the ability to service its own debt, that's inherently a riskier loan, and therefore it's going to be priced accordingly. Now, rates are available in low 7s with origination fees as low as 1%. Like I emphasized on the last slide, this is going to be an A++ borrower. And again, very unlikely to see that lowest rate threshold and that lowest origination fee. But again, for the right borrower, these terms are possible. And like I mentioned before regarding the prepayment penalty, standard is a 5-year declining. You have the ability to buy it down through points or in addition to the rate. And some states prohibit prepayment penalties altogether. And again, I would emphasize this program is even more competitive when you compare it to traditional lending institutions, because many of them will not finance a property whatsoever that's cash flow negative. It's not out of the question, but a lot of them would turn it away at the door. So to be able to secure something in the 7s, right, with a property that's cash flow negative is frankly very impressive, in my opinion. So for an example here, we had a property, a duplex in Atlanta. This is actually a friend of mine. I was born and raised in Atlanta, and he wanted to get a rate term refinance on this property. He had purchased it on a bridge loan, which was a little bit more expensive, and now that he's got good tenants in place, right? Maybe not quite enough to service the debt, but got good tenants, and he believes in the long-term value of this property given the location. He came to us wanting to refinance out of that bridge loan. So decent experience, decent FICO. We're able to secure him a 70% loan to value, which is the maximum here, at a rate of 6.5%. So again, very, very competitive terms. And I think that's actually a typo. I think it's supposed to say 7.5%. Obviously, we said rates would start in the low sevens here. So that's a mistake on my part. This rate would have been 7.5%. And again, in the best case scenario, maybe 7.125%, 7.25%, something like that. And again, this is a very organized individual, had everything ready when we asked him for it. Loan closes in 17 days, which is, very near record breaking, I would say, in terms of how quickly these can close. So that emphasizes the importance of being organized and being efficient when it comes to providing what is needed. All right, so the next program we want to cover is going to be the second mortgages. So I'm sure everyone on this call is familiar with a second mortgage, but just to recap, a second mortgage is offered, and what that means is there's already a loan, a first position loan on the property, and so you're now going to access property equity. It's almost always a refinance. So you're going to use the second mortgage to access property equity, right? And so this is, I guess the best use case here is what Craig mentioned earlier, where someone may have bought a property when rates were very low. Maybe they have a mortgage at 2.5%. They're now down to a 50% loan to value, but they need cash for other investments, right? Second mortgage is a perfect tool to access that equity in the property without touching the first mortgage. Now, as you can imagine, a second mortgage, given that the second lien holder, it's basically second place in line to get repaid if something goes wrong, then, this is a bit of a riskier proposition. And so therefore it's going to be priced accordingly. Now, while the rates may be a little bit higher, as you can see here, starting in the mid nines, it's important to consider what is the blended cost average for your customer. So again, on paper, it may look like a very high rate, but if they have a first mortgage at 60% of the property's value at a 2%, doesn't really make sense for them to go refinance into a 7% loan when they could just go access a little bit more money, albeit at a higher rate, but overall a better cost of capital as a blended average. So again, best case terms here, we're going to max out at a 30-year fix, no ability to go to 40 here. The combined loan to value can max out at 75%. If anyone on the call is unaware, the combined loan to value is essentially the value of the first position loan plus the second position loan that we're securing divided by the property value. So it's essentially looking at both mortgages and assessing how much equity does the borrower have in the property. To do something like this, they need to have at least 25%. All right. Rates start in the mid 9% range, so around 9.5%, with origination fees as low as 1.5%. And again, I will note for this program, we have very limited options. As you can imagine, not many lenders want to sit in a second position. And so, we're going to require a minimum DSCR of 1.0 to kind of, mitigate risk for them in a way. And again, there's not as many options here. So finally, same thing on prepayment penalty. The standard is a declining 5-year. You have the ability to buy it down. Some states are exempt. One more thing to note here, because our programs for second mortgages are very limited, we cannot finance rural properties. So there's actually a tool that is produced by the USDA, if some of you are familiar with this, where you can put an address in on the USDA.gov website and determine if a property is rural. So it's if you have an address in question and you're not sure if it's rural, you can use that tool to look up, is it a rural property or not? Another rule of thumb we kind of follow is if it's in a town of 25,000 people or less, it's going to be considered rural, unless it's within 30 miles, roughly speaking, of a major metropolitan area. So, for example, if you're in a small town outside of Atlanta that has 10,000 people, but it's 20 miles from Atlanta, something like that's not going to be considered rural. So just one thing to keep in mind, if you have a borrower looking for a second mortgage, make sure you're aware of the location of the property to know if it's a good fit for us or not, so you don't spend too much time on it. And again, comparing this to traditional lending institutions, right? Like I mentioned, it's very, very uncommon product offered by these credit unions and banks, and therefore finding something sub 10%, even if it is in the 10.5, 11% range, very competitive, not very easy to find. So we'd love to be a resource for these requests. So by way of an example here, we had a customer wanting to access some equity in their condo in Orlando, Florida, right? So it's $1 million property. I believe I kind of mentioned this example a little bit earlier, but they had $500,000 in debt on the property. Property was most recently valued at $1 million. They have some other projects they want to work on. They need to access some cash. So they come to us, they request a second mortgage on this property. We're able to take them up to that combined loan to value ceiling of 75% and access an additional $250,000, right? Again, very motivated, organized borrower, gives us everything we need as soon as the term sheet is signed and in, and we close it in 19 days, right? So this is, again, very competitive, and I would argue not the easiest request to get approved, right? And very advantageous to the borrower because now they can go on with their life and start working on these other projects and investments without having to spend the years saving up. They can access this equity they've already built up. All right, so the last product I want to discuss is a bridge loan. I'm sure many of you are familiar with the bridge loan. If you're not, it typically refers to a short-term loan with interest-only payments. So use cases for something like this. Perhaps your borrower has a very good opportunity to buy a property well below market value, and they're really confident they can sell it within 2 years for a decent profit. They don't want to do any work to the property, but they don't want to get locked into, for example, a DSCR loan with a 5% prepayment penalty in the first year if they think they're going to sell it. That example is perfect for a bridge loan. Another one would be if you have a borrower who does fix and flips. Now, we're not going to talk about fix and flips today. That will be our next webinar. But as an example, if they've identified a property that's a great candidate for a fix and flip, and they've got a competitive purchase price that they've negotiated, but they don't have their budget ready. They haven't hired a GC, right? They just want to get the property bought and make sure they don't lose this opportunity. Bridge loan is perfect for something like this. So terms on this are generally in 6-month increments. So we can provide a 6-month bridge loan, a 12-month bridge loan, up to 24 months, right? So you can do 18. There are ways to negotiate there as well. Most of the requests we see are either 12 or 24 months. These are going to be interest-only payments. Obviously, a very competitive offer and helps them, manage their cash flow, especially if they're doing other projects, they're saving up for a rehab budget, something like that. Loan to value here is going to go up to 75%. I will note that 75% is reserved for, again, A++ borrowers, right? So most of the bridge loans we fund come in at the 65 to 70% range. Before the right borrower, the 75% is possible. Again, similar to second mortgages, rates starting in the mid-9s, origination fees as low as 1.5%. The reason these loans are priced a little bit higher is, generally speaking, they're also riskier propositions for lenders and investors. The reason being that while your borrower may be confident in their business plan and their exit strategy, it is inherently more risky to trust a borrower's exit plan rather than have them locked into a 30-year loan. The other reason is that when you have a borrower locked into this 30-year loan, especially if you have these prepayment penalties, your guaranteed revenue from this loan is just inherently higher than just 12 or 18 or 24 months worth of interest payments. And so it's priced higher to make it worth their while, so to speak. So again, you can get something in the mid-9s, origination fee as low as a 1.5, a little bit of give and take there, and that's going to be for the best borrower. As their FICO goes down, as their experience goes down, those numbers tend to trend up. Now, prepayment penalty on this varies widely. We do have the ability to provide these bridge loans with no prepayment penalty. However, a good handful of lending institutions and our programs require 6 months of minimum interest. In the case of a 12-month loan, if they pay the loan off in the 4th month, they're going to owe a remaining 2 months of interest, right? But again, the purpose of this program is to allow people to have the flexibility to leave the loan if they need. So the prepayment penalty terms tend to be less punitive, if you will. So an example here, we had a customer This particular example was the second example I mentioned. So customer wanted to buy this townhome. They wanted to do some rehab to the property, right? They felt like it was in a very nice luxury neighborhood. The house wasn't quite as nice as the one on the left and the one on the right. They're going to put some extensive rehab into the property. But at this time, they didn't have the contractor identified. They didn't have the budget put together. They were not qualified to go get a rehab loan. And so they come to us and say, hey, I've got a really good opportunity to purchase this property well below market value. I'll sort out the budget and everything later. Can you just help me get it bought? So as you see here, this was the fastest closing timeline, 15 days, and we were able to get them 65% of that home's value at a rate just shy of 10%. Again, a very competitive offer, and probably in a few months here, this borrower will come back with their budget in hand and ready to secure a rehab loan and kind of follow through the back half of this project. And so again, terms on this, fairly competitive in the market. I will be honest, if you wanted a bridge loan, let's say you have a relationship with your local bank and you want to go through a 60-day closing and provide all of your tax returns, you can certainly access a cheaper rate in the market, maybe something in the 8.5%, 9% range. So the intent of this project is not necessarily, or this program is not necessarily to be the cheapest. It's meant to serve a particular need of certain borrowers. So it may not be the fit for everybody, but for those that it is a fit, this is a tool that's going to let them get started on a project that they believe is going to net them great returns in the future without having to get hung up on a 60-day closing, spend time putting together a rehab budget, and ultimately possibly losing out on the ability to buy one of these properties. All right, so now that we've covered all the different programs that we offer in this 1 to 4 space, I want to briefly talk about what sort of documentation is going to be required to close. So like I mentioned kind of near the beginning of the call, all of these programs I just outlined are considered fairly light documentation programs, meaning, like I said, we're not requiring tax returns, we're not requiring proof of personal income, and we're not requiring all your borrowers K1s if they run businesses, they're entrepreneurs, etc. Right? So this list here is the high level items that are going to need to be provided once the quote has been accepted, the term sheet's been signed, to push towards final closing. So the first is their credit report. Obviously, we will price the deal based on their self-reported FICO, but we need to actually have a hard pull and review their credit history before we actually can close the loan. The second is the appraisal. I will say we have a select few programs that do not require an appraisal. Instead, the institution in question will perform their own internal evaluation of the property and assign a value. But like anything else, this comes at a cost, right? So they're not paying for the appraisal, they're doing it themselves, and their loan's going to be priced a little bit higher. But this is for a borrower, particularly that's on a very tight timeline, this no appraisal option can be very beneficial. Then you're going to need to provide entity documents, right? So articles of organization and things like that for the LLC that they're going to be closing in. You're going to need to provide proof of insurance. That's always going to be for any loan, 1 to 4, commercial, or any loan we ever talk about, that proof of insurance is going to be required. And then finally, in the case of refinances, we're going to want to see the leases. So for the DSCR loans, leases aren't necessarily required on a purchase, but they would be required on a refinance. And finally, for refinances where there is existing debt, we're going to need a payoff letter from whoever currently holds the loan. Now, if you come to us and you want to cash out refinance on a free and clear property, obviously there's no payoff letter. I'll emphasize this list is not exhaustive, but these are kind of the high level items that I'm sure everyone on this call is aware of that we're going to need to be providing prior to closing. And so again, if you come to us with a request and you know there's a strict timeline, let's say, for example, you know that the borrower doesn't have insurance, this is something you want to start pushing them or helping them work towards early on in the process, right? If they're forming a new entity, these are things you want to be teeing up early in the game, because every little piece of documentation that has a delay in it is ultimately going to cause the loan closing to get delayed a little bit longer. So I think it's very important to understand what's going to be required on the back end, even if you're not submitting it at day one. So with that, I appreciate everybody's focus and attention during that segment. I'd like to pass it back to Cray now to wrap this up.
Thank you, Thomas. while everyone's working on their questions, I'm sure there's going to be some great questions in the Q&A. I want to highlight how your partnership with Loanspark works. I know we have current partners in this call, and we have prospective future partners as well. So when it comes to submitting leads with Loanspark or funding deals for your applicants, our number one goal is to help you fund every deal. Okay, and there's a couple of different ways that we can help you do that. Number one would be our referral option, right? So essentially, you're able to hand off lead to Loanspark. You would let your client know that you have a financing partner in place who does this type of loan for them and would be reaching out, which allows you to focus on your bread and butter. So a few ways where the referral type process works better for certain partners is, for example, if they're working on a deal that they're not necessarily comfortable moving forward with. We see this a lot with loan officers and partners who are embarking on their first commercial real estate deal or their first DSCR loan, and they don't necessarily know the best way to move it forward. That'd be a great example of a way that you would just simply refer it to Loanspark and trust that it's in good hands with our team of 30 plus years of experience. So in that case, you would not necessarily need to chase down the documents from the borrower. As Thomas mentioned a moment ago, the more information that you can provide upfront ensures a higher success rate of closing the deal, a more streamlined process, and the ability to identify potential issues upfront rather than later on down the road. So more information is always better on your end, even through the referral process. However, it's not necessary for you to collect the documents. What we will do is if you refer a deal to us, we will actually reach out to that borrower and we will walk them through step by step what type of documents will be necessary, how to provide them. We'll review it on our team, and we'll be sure to guide them through any next steps or questions that they may have. In this scenario, it would be a payout of 20% of the gross margin to you, allowing you to finance deals that otherwise you may not be able to finance, but still be able to make some money and trust that your clients are being serviced, with industry-leading terms and with an industry-leading team. So in that case, we would work with the applicant directly. We won't necessarily need to reach out with you. You will have access to the partner portal, so you can still keep close tabs on the deal and track the status of that through your partner portal. But that's essentially the referral process in a nutshell. Alternatively, we offer a brokering ability as well. So you're able to use Loanspark as the lender, and you would control the deal process as well as be the point of contact, basically, or the glue between Loanspark and your client. So if you're able to, if you prefer to broker a deal, you're actually able to upsell, basically determine the amount of points you want to make on the deal based on your relationship with the client and what you're able to sell, right? So you have more control over the process. You're able to typically make more revenue on the deal, and that relationship with the client stays your own, right? In that case, we will require you to come to the table with a clear picture of what's going on, right? You'll have to collect the documents on your end, but we're still working with you and supporting you directly. So even if you have questions about what documents or what terms may look like, or maybe what the best program would be, we're still here to support you, and we can still provide that professional guidance to you in that case as well, because you'll still have access to all of our 100+ lending programs. I do want to highlight real quick, again, this is all going to be in reference to business purpose lending. We don't do anything on the primary or consumer mortgage side. So that's something to note. And all of the programs that we covered today during this presentation, you're able to refer with us and broker through us. And an important note also is that you're not locked into one way or the other over the duration of the partnership. I've seen examples where partners come to us and want to refer a deal one time for the first time to learn a little bit about how it works or get a feel for that particular loan program. And then once they get a handle on things, they come back and they broker the next one with us. So you can always switch and do this on a case-by-case basis, depending on the needs of your clients and the goals of yourself. Before we go into the Q&A, I want to kind of touch on our upcoming webinars as well. I mentioned that this is part one of a 3-part series for business purpose real estate financing. Today, we covered 1 to 4 unit investment properties. And in 2 weeks, we will be covering fix and flip, rehab, and new construction loans. So that will be another real hard hitter that I encourage you to attend. Part 3 will be 2 weeks afterwards on the 23rd of October, and we'll be covering financing commercial properties. So definitely be sure to stay tuned and engage with us during all of these webinars in the 3-part series. And then afterwards, we'll move into equipment financing, which we're seeing a ton of demand for and interest in. So we'll do a deeper dive on that topic on November 6th.